Alright guys, time for another week ahead video. This week's video will cover the trading week running from the 3rd to the 7th of May 2021, and our attention this week will turn to the British pound, with of course the upcoming Bank of England meeting taking place on Thursday. Now for those of you that don't know, about a week ago the Bank of Canada actually took the policy normalization lead among the major central banks by deciding to firstly start tapering their quantitative easing program, and they also took a more hawkish tilt by bringing forward their rate hike projections to 2022 from 2023. Now the big question for this week's upcoming policy meeting for the Bank of England is whether the bank has enough conviction in the current economic recovery to follow the Bank of Canada's lead. Now, if we take a look at something like the rates market, it does seem that the rates market right now seems to think so, as they've been steadily pricing in faster policy normalization for the Bank of England. If we take a look at this chart, this is the SONIA quarterly futures, and we can see that that is currently pricing in a first rate hike by the Bank of England as soon as September 2022. That is much faster to the markets expecting a first hike from the Fed as soon as March 2023. And if we take a look at the March 2023 contract for the SONIA, we can see that that is actually pricing in a total of 3 hikes by the Bank of England, assuming of course 10 basis points of movement at a time. So from a rates market perspective, rates markets are definitely betting on a much faster policy normalization path for the Bank of England compared to that of the Federal Reserve. Then if we take a look at the growth outlook remains positive and much higher right now than what the BOE was previously expecting. According to a recent Bloomberg survey, the consensus expectation is still looking for growth around 5.4% for the UK economy in 2021. However, it's also important to always have a look at that high frequency data, and that is looking very, very positive. If we take a look at this data, according to the Office for National Statistics, we can see that debit and credit card spending is at 110% of the February 2020 average. Seated dinner reservations are currently at 62% of the equivalent going back to 2019. We can see total footfall in the UK is at 80% of the equivalent going back to 2019. Traffic data right now is sitting at 93% of levels seen in Feb 2020, and cargo tanker visits were 11% higher compared to the equivalent, once again going back to 2019. So even though consensus still sees 5.4% GDP this year, due to this recent positive high frequency data, some participants like Barclays is currently expecting growth in the range of 6.4% this year for the UK economy, which from an annualized point of view goes back to the 1950s, and Goldman Sachs actually expecting growth close to 7.8% for the UK economy, and that is even higher than what they're expecting from the US economy. So from a growth point of view, everything is still looking very solid right now, especially in terms of the high frequency data. Also taking a look then at those leading indicators, we've seen the market flash PMIs continue to showcase the positive growth picture. The composite measure saw a huge jump in April to 60 from 56.4, and that was way above what the markets were actually looking for, which was a print of 58.2. Now, this relative growth dynamics between countries like the US and the UK, where vaccination programs have been a huge success, is very clear when we compare something like the growth output against nations like the Eurozone as well as Japan. And this divergence is especially clear when we look at something like the services part of the economy, where vaccination success has allowed a much faster reopening of businesses, especially businesses like bars and restaurants, etc. If we take a look at the April market flash PMI data for services, that saw a huge jolt higher for the UK, coming in above 60 from a prior of 56.3. Now, the faster reopening of the economy has also seen already a positive impact in the jobs market, with the ONS as well as this Bloomberg article reporting that data from Adzuna showed online job advertisements have already managed to climb back above the levels seen before the pandemic. So a very positive sign also from the labor market point of view. And apart from that, the vaccination rollout is just going from strength to strength. Right now, we can see that more than 70% of the UK's population has already received that first vaccine shot, and roughly 22% of the total population has been fully vaccinated. So these charts just shows the clear outperformance in the rollout for vaccines in the likes of the US and the UK, especially versus the other developed nations. So it seems that a lot of the positive boxes appear to be ticked right now for the Bank of England to potentially start normalizing their ultra easy policy. So turning then to the week ahead, the big question is whether the Bank of England will see the glass half full or whether they will choose to err on the side of caution and keep easy policy going for a little longer. Now, apart from the question about tapering, the BOE will also be releasing their quarterly monetary policy report. And given the recent high-frequency data as well as the vaccination success, the bank is expected to see sizable upgrades in both growth, inflation, as well as employment projections. Now, these upgrades shouldn't really come as a surprise to markets. And right now, it's also interesting to see that the consensus is also seeing no tapering change potential for the Bank of England in this upcoming meeting. But there is, however, a growing cohort of expectations among a few participants like ING, NatWest, Citigroup, and Bank of America, who does think that the bank could announce a reduction in asset purchases as soon as this week's meeting. So far, those who are expecting the bank to deliver on tapering this week is looking for a very similar shift like we saw from the Bank of Canada, looking for weekly asset purchases to be reduced from the current amount of £4.4 billion down to between 3 and 3.7 billion pounds in gilt purchases. Now, the reason why a tapering decision would make sense is because the bank will be reaching their purchase target within the next couple of months, well before the end of the year. So reducing purchases to ensure that the program continues to run until the end of the year would make sense in that regard. That way the bank can make sure to keep the support running as the government's job retention support also runs out, of course, running into September. However, whether they stop a few months before the year or reduce purchases to keep them running until the end of the year isn't really that much of a difference if you think about it. I mean, according to ING, the growth numbers right now are also inflated a little bit due to the inclusion of COVID-19 testing and vaccines into the GDP figure. So that has artificially lifted the level of activity quite noticeably, according to the bank. And there's also a real risk of unwanted volatility from a tapering announcement at this week's meeting, because if the Bank of England frames the decision merely as a technical adjustment, not due to a better outlook, just as a technical adjustment because they want to see purchases running until the end of the year, that could really be a nightmare to trade, because arguably it might see that initial knee-jerk reaction higher in the pound and gilt yields as well. But that could also be followed by a very quick downside move once the market digests the information and says, but hey, hold on, it's not because they're more positive, it's just because they want to keep these asset purchases running until the end of the year. So, with all of this in mind, there's also valid reasons for those that do think that the bank will just keep things as is and allow that target to be reached a little bit earlier than the end of the year. The other risk factor to watch in the week ahead is UK local as well as Scottish parliamentary elections. Now, as we noted in our videos this week, the market's reaction from this is expected to be a little bit marginal, but the event could spark, of course, some risk premium adjustments in sterling as well as gilts, depending on the outcome. Now, there is or has been a growing push among pro-independence officials, of course, for another Scottish referendum like we had back in 2014. Right now, the pro-independence SNP is set to possibly win a majority. But even if they don't get an outright majority, the performance of the likes of the Green Party means that a pro-independence majority is almost a done deal right now. This should theoretically be a negative input, of course, for the pound, given the risk of a possible second Scottish referendum. However, according to ING, they don't think that a majority win will necessarily be a big deal for sterling. Because the 2014 vote, that didn't really translate into a material build-up in terms of pound risk premiums. And even if a majority is reached, a referendum could be years away rather than months away, according to the bank. Now, this is because the UK government currently, obviously opposed to another vote, would need to grant their approval via a Section 30 order. So the riskier outcome from an SNP majority isn't just a majority win itself, but that is if the new government decides to come out and says that, hey, you know what, we're going to try and pass legislation that aims to allow for a second referendum without the need of a Section 30 order. That, of course, if that should happen or we see comments in that light, that could, of course, be a more negative outcome for the pound. So it is definitely a risk factor to watch in the week ahead, but we definitely think that in terms of the BOE, that should be the biggest mover for sterling in the week ahead. So then looking at a few possible bullish and bearish outcomes and the potential asset impact that we can expect from that. Starting with potential bullish outcomes, the first one would be if the bank does step up with tapering asset purchases. Of course, that is expected to see that knee-jerk reaction to the upside and things like the pound, as well as gilt yields. The one caution just here, once again, is if the bank does do that tapering, but they say, hey, don't get too excited, this is really just a technical thing because we want to keep these purchases running until the end of the year, that might take the wind out of the sails of that type of announcement. So just do keep that in mind. The other more positive one that we'll be looking for is if we see the Bank of England, just like the Bank of Canada, actually bringing forward their rate hike projections. That'll arguably be one of the more positive bullish factors that we can look forward to see some additional upside in the pound, as well as gilt yields. The other potential bullish outcome would be if we do see the S&P actually not winning a majority. Again, not expecting a whole lot of impact from this one, but it will be a risk factor to watch. And if we see absolutely no mention being made of a Section 30 legislation plan, even if we see a majority win, that is also expected to not really see upside in the pound, but not to see any negative influence coming out from that, if that makes sense. In terms of bearish outcomes, expecting the exact opposite. If we see them staying put with tapering, because there has been so many investment banks and participants looking for potential tapering, even though it's not consensus, because there has been a lot of them, it could see some upset in the market if we don't see any type of tapering announcement coming out. That could see some downside in the pound and gilt yields. Apart from that, if they keep their rate hike projections unchanged despite upgrading their growth and inflation and employment metrics, that can also be seen as a negative, because there has been a couple of participants coming out saying that they're looking for a similar type of move from the bank, and to see that happening for the Bank of England as well. So that is something to watch. If we do see the S&P win a majority in terms of that Scottish elections, again, we're not expecting that to be a major mover, but we could start to see some risk premium being built in, especially if we see them making comments that they plan with that majority, if they do get one, to try and pass legislation to have a referendum without having that Section 30 order. That arguably can be a more negative factor for the pound in the week ahead. Now, the one important caveat just to keep in mind is the FTSE 100 and that inverse correlation that we normally have with the British pound. So that means that even though the same factors should be bullish and bearish for both assets, that is the pound and FTSE 100, a strong move higher in sterling could actually be negative for the FTSE 100, and similarly, a very strong bearish reaction in sterling could actually be more positive for the FTSE. So that's just one important caveat that we do need to keep in mind for the week ahead. Also remember that the potential outcomes and the potential market reactions in this report is merely a guide for what we would expect in the event of these various outcomes. And please do keep in mind that the market can always surprise in the way that it reacts. So the expected impact is never intended as a trade call, but rather just intended as a guideline and a framework for your own scenario planning. So guys, that is everything from our week ahead video. Hope you guys will have a fantastic trading week ahead. And as always, any questions, don't hesitate to let us know.